This is Money Made Simple, the financial podcast that keeps it simple and gets to the point.
Kia ora and welcome to Money Made Simple with Simplicity. I'm here with Liv.
Kia ora.
Hi, Liv. And we're in this lovely new studio, Fanatical Studio.
For those who are watching
us.
Rather than listening. Yep.
I could explain it if they were listening, I guess.
No, let's not.
Okay. And we are here today to talk about something super exciting.
Very, very exciting for us both, personally as well, right?
Yes. So we're only just through the first quarter of the year, but we're past the end of the financial year.
Yeah. March 31st.
Yes, and that means that people are thinking about tax.
Well, people probably aren't thinking about tax, but in the KiwiSaver world, it's a big thing. So tax statements will be coming out in mid-May, and that basically is when we send out tax statements to all our KiwiSaver and investment fund members. And that's when we start getting a barrage of questions through our investor services team about tax. So we thought that we would create a podcast that tackles the most common questions that come up over and over again every end of tax year. And yeah, just make sense of it all, because it's not really a word that either of us like, right?
No, I mean, to be honest, when I hear it, I just switch off automatically.
Yeah, I shrivel inside a little bit.
So we're going to try really hard to keep this simple, straightforward and useful for people. If we can make it amusing or entertaining along the way, we'll try.
Yeah, if you have even one laugh in this, then we've done our job.
The thing about tax is that it is both confusing, boring, and actually some people resent paying it as well. So it's a real triple threat. But I think it's useful to understand how it works. Let's start just by quickly framing it. This helps me, just putting a bit more of a positive spin on tax. We pay tax on our income and on our investments.
We also pay tax on other things, right?
Like on petrol, on
goods and services.
Yeah, it's just an everyday part of life. But it is paying for some really important things like schools, hospitals, parks, libraries, roads.
All the stuff that the government funds is basically paid for by taxes.
Yeah.
It's a funny one how people resent paying tax or try and get out of paying as much tax, because you're paying to something that's largely positive. Yeah, not just society, for you as well, right? Like when you go to the hospital and need top-notch care, your tax have helped pay for that.
Every time you get in your car and drive on the road, your tax is paying for the quality of those roads.
You're right, it helps to frame tax as not this super negative thing that you're just paying and not getting the benefits of. You pay and you get the benefits of it.
Yeah. And if you look around the world, New Zealand's tax system is actually quite moderate in comparison to some.
Yeah, if our highest income tax rate in New Zealand is 39%, right?
Yeah.
Then you've got Sweden, Denmark, over 55%. Even Australia and the UK is higher than ours, around 45%, so we're lower than them.
Yeah, so just putting it into context, it's somewhere in the middle.
Yeah, so let's start with one of our number one questions that people ask. So we're going to just debunk/ask the question, and that is around whether KiwiSaver is tax-free. And so people either ask if it is or assume that it should be, and why they would pay tax on their retirement savings.
Which I kind of understand. Like, there is an argument that it could be tax-free, but it is not. So it is taxed at a couple of different points. I always forget the acronym for the employer contribution tax. You always remember it?
ESCT.
Yeah, there you go.
I couldn't tell you what that stands for because I always get the actual words wrong, so I'm not going to try this time.
Okay. And then your contribution has been taxed as part of your income tax. So that's been taxed prior to being put into your KiwiSaver account.
Okay, so your income tax applies to your
100% of your income.
Yep. And then that post-income tax amount then goes into your KiwiSaver, whether that's 3, 4, 6, 8, 10.
Yep. So that means both contributions have been essentially tax going in. Once it is in the fund, you don't pay tax on your balance, but you do pay tax on the income that your fund is earning.
Okay, so that's a really important point there, because I see a lot of people talking about being double taxed. So that amount that you have contributed and the amount that your employer has contributed, both which have been taxed in these different ways, that does not get taxed again.
No, only the money that money earns gets taxed within the fund.
Okay, cool.
And then you don't get taxed when you withdraw the money. So it's called a TTE system. So tax exempt.
Good.
Yes,
easy acronym to get right.
And I know the words.
That's what New Zealand, the higher power, decided. And I think another important point to note is, as KiwiSaver providers, we don't have any say on how, when, why things are taxed in KiwiSaver. We also don't keep your taxes when they're paid, which I think is another bit of a kind of misnomer. We pay tax on members' behalf.
Yep.
So that money that's taken out of people's funds for tax is immediately passed on to the ARD.
The next question is around how the funds are taxed. So we talked about the contributions are taxed, and then it's taxed within the fund, the income.
Which sounds like a bit of a confusing thing.
So let's explain what we mean by taxed inside the fund.
Yes, okay. The majority of KiwiSaver funds, including all of the Simplicity KiwiSaver funds, are what we call PI funds.
Sounds delicious.
PI funds stand for Portfolio Investment Entities, and that offers a slightly more tax efficient way to invest. But understanding the tax rules of a PI fund can be a little bit challenging, right?
Yeah, you need to understand how the PI works first, and that is it's a managed fund, and as an investor, you are pooling your money with other investors, and you all own a bit of that fund. So you don't own individual shares, like I don't own a bit of Air New Zealand or
Apple.
Apple. I own a bit
apple pie.
of the fund. Oh, that's a missed opportunity, apple pie. The pie analogy does work here actually because you own a slice of that whole pie. All the ingredients all mixed up.
Right, so then when we say you're taxed within the fund, you are actually just paying tax on your slice of the pie,
Yes,
right?
that's right.
Yeah.
The fund manager is paying the tax for
Yes.
the fund to the government, and
Yep.
then you pay for your little bit of it at the end of every tax year.
Yes.
Now, the trouble is the way investments are taxed is quite complex, and all of those little investments, all the ingredients in your pie are all taxed at slightly different rates or in different ways.
Yeah, so your funds are made up of things like bonds and shares, which have tax
Yeah.
done in different ways, and also tax regimes vary across different countries. So we'll start with New Zealand. Basically, you are taxed on the income from your fund, not on the capital gains, but the income like dividends or in the case of bond interest. That's New Zealand. International shares and bonds and other assets are a little bit more complex.
Yes, so international shares are taxed under the FDR regime. And bonds, which is the foreign dividend rate regime. And that is worked out quite differently. So they assume a set return on your foreign investment of 5%.
And that's regardless of whether that share or that bond makes more or less than that. It's just basically think of it as an easier way to work it out.
Yes. So in some years, when maybe you've made a much higher return, you're only paying tax on a 5% return. So that might feel quite good. When you've perhaps made some losses,
Like recently.
yes, you are still going to pay that set rate of 5%. Then on top of this, we have to apply our own prescribed investor rate, the PIR rate. And we explain how that works.
Yeah, so we've talked about how tax is treated and then how much percent tax rate you pay. It's not based on your income tax rate. There's a specific rate that you pay tax under PI funds called the PIR or the prescribed investor rate.
Yeah, and there's three set rates.
Yes.
10.5, 17.5,
yeah.
and 28.
So that's the rates of tax you pay for any PI structured fund.
And actually, they are based on your income, but they are not the same as your income tax.
Yeah.
So you work out your PIR, your prescribed investor rate, by looking at your previous 2 years' income. We got one, I think, good example.
Yes, let's imagine you have a fund that is 100% international shares, for example,
Okay.
which isn't actually the case for our KiwiSaver diversified funds, but we just try and keep this example as simple as we can.
Okay, so say your average balance over a 12-month period is $20,000. That means that the set 5% return rate would be $1,000.
Because that's 5% of 20,000.
So that is the assumed rate of 5% return. You are going to pay your PIR tax on that. So say mine's 28, I'm going to pay $280 on that assumed $1,000 of returns.
Cool. So you don't pay tax on the whole amount that you had. You're just paying tax on the $1,000 of income at that assumed 5% rate for overseas assets.
I think that makes sense.
Cool.
I hope it makes sense to our listeners /
You might need to rewind and listen again, or maybe we could have said it better, but it is complex. So basically, the administrator of your fund, which in our case is Apex, works out based on the prescribed investor rates of each investor and the different types of assets, whether they're overseas and different asset classes. They work out per investor what that total amount of tax.
What your little slice of that pie,
Yes.
what tax you owe on that according to all those different complex tax regimes plus your prescribed investor rate. But it is only realised either when you make a withdrawal or you switch funds or the end of the tax year.
So when you say realised, you mean like paid from your fund?
From your fund, yeah.
Okay, cool.
And
So-
to do that, they would need to sell some of your units, some of the bits of pie, to then pay the tax bill. The tax is calculated daily. So if you go into your Simplicity app, for example, at any point you can see the tax that you owe.
Okay, so basically it accrues, and on your account summary page, you'll see that you would owe for this period a certain amount of tax. It's not actually paid.
No, you will only pay it at those moments. And in some ways that's quite good because that means the money that you would pay in tax is actually sitting in your account, earning money.
Earning income
itself.
and all that.
Yeah.
Okay, cool. All right, I feel like that's enough around how we actually pay tax. Another question that we get very often is, why do I have to still pay tax when I made losses?
Yeah, I think this is a completely understandable and fair question because that can seem quite hard. But you are paying tax on the income that your fund has made over any given period. One of our colleagues explained it in a way that really made sense to me, and that was if you have an investment property, the capital value of that property may go up and down at any given time, but you are still paying tax on the rental income.
Right. So you're making an income regardless. It doesn't account for the capital value of the property.
Yeah.
And so same as the fund, it's still making dividends and interest payments if it's bonds.
And we know the market goes up and down, but over time, and remember KiwiSaver in particular is a long-term investment. So over time, your investment is going to grow.
And of course, sometimes you're going to make a loss overall on your KiwiSaver for the year, and you will still have tax owing. That is because that's how the PI tax regime or the tax rules work. Let's go back for a second to prescribed investor rates. How do I know if my PIR, my prescribed investor rate, has changed?
You can use the IRD's PIR calculator. You can put all your numbers in and it will tell you what your PIR should be. You can change your PIR with your provider. So with Simplicity, for example, you can go into your My Info section and change your PIR at any time. If you get your PIR wrong, the IRD may change it for you. So they send information to providers to say this PIR is not set correctly, and they may override what you have put in there.
Also, just a warning, if you do set your PIR too low thinking I'd rather pay less tax, you will very likely get stung because the IRD does monitor, like you've said, and either change it or you'll owe a whole lot of tax at the end of that tax year. So
the other way, so your PIR is set too high and maybe your income changes, you lose your job or you change jobs, you actually have to follow them up or put in a return to get any tax that you have overpaid.
yeah, so it's
a little
worth
bit harder.
knowing and worth using that IRD calculator, which we'll chuck in the show notes, to work out what your PIR should be.
Yeah.
What about if we move overseas, which lots of people are apparently doing at the moment?
Yeah, again, this is one where people kind of assume if they're overseas, they're not using all those parks and libraries and roads in New Zealand and that they don't have to pay tax. But actually, they do have to pay tax on any New Zealand investments, and it automatically goes to the highest PIR.
So don't move overseas.
So if you're not already at 28%, you will be at 28%.
Good to know. What about for those investment fund joint accounts so one person's earning loads, one person's earning not much, and you have different prescribed investor rates?
Yeah, it goes to the highest rate. So if you've got a 28% rate and your partner has a 17.5, then the whole investment will be taxed at a 28%.
So it's not
rate.
worked out
No.
at half and half.
No.
How about if you set up an investment fund for your kids?
Yes.
How does the tax work on that? Because the kid's not earning, right?
Well, probably not.
Probably not.
So they're likely to be at 10.5%, the lowest rate, and that's the majority of kids. But there's probably some like hustler entrepreneur kids out there or child stars.
Yeah, I was thinking child stars, like actors like that are earning $1 million a movie.
So if they have taxable income of over $14,000, then that might affect their PIR.
So kids' investment fund accounts are not tax-free.
Yeah. But at the lowest rate.
Yeah, in the most cases, unless they're a bougie child star, they're going to be taxed at that lowest 10.5% PIR.
You got it.
Okay, cool. Something that people often ask, and people get a little bit miffed at why they paid higher tax this year than they did last year.
Yeah. Well, I actually think you should be like, yay.
Stoked.
Yeah, because if you paid higher tax, it means one of two things. Either your income has increased, so you've moved into a higher PIR level.
Bracket, yeah.
Yes. Or your money has made more income. So
Right.
you've had a really good year, the income has been higher, and so you've had to pay a higher rate of tax on that. Because remember, the tax that you pay within the fund is only on the income, it's not on the balance.
I think that's a really good way to think about tax in general. You pay more tax if you've earned more money.
Yeah.
So really,
Don't feel sad about it.
Yeah, exactly.
Yeah.
Feel stoked about
Yeah.
it. Like you're able to contribute to society more because you've earned more money.
Yeah.
Cool. Finally, why did the amount of units I had in my KiwiSaver fund drop at the end of March?
Yeah. I think we've kind of explained this already. We have to sell units within your fund to pay for the tax.
Yes. Okay.
It's not held in a separate
No, your
account.
KiwiSaver fund is made up of units,
Yeah.
and you own a certain amount of them. Your slice of pie is a certain amount of units. And so the way that money gets taken out to pay IRD,
Yeah.
to pay the government, is that you have to sell down that amount that you owe.
Yes, correct.
Okay.
And I think, unfortunately, in the last 5 years or so, there have also been quite significant market events that have just happened to coincide with the end of the
March.
financial year. So a few years ago, we had COVID.
5 years exactly.
5 years, yeah. And then more recently, like very recently, we've had the tariffs and trade tensions that have really caused some volatility in the market.
Yeah.
So when you're paying your tax bill and at the same time the markets drop, it can look like a really significant...
Yeah, it can seem like a double shit, basically.
But it's really, it's just unfortunate. And as they always do, the markets will bounce back and you'll keep contributing to your KiwiSaver. It'll start to track up.
We totally get that it does feel probably unfair. As we kept saying, over time, your fund is generally going to go up. This is just not a great time for it at the moment.
Just hang in there.
Yeah.
Yeah.
Exactly.
So those are the main questions that we get from members. I think if people have other questions about tax, which they might do, there's loads of resources and we're going to drop them into the show notes if people want to know more.
I guess that's the question is, off the back of this, what can listeners do? I think it's not much. The biggest thing is making sure that your prescribed investor rate is correct.
I mean, look at your statement. Whoever your provider is, you'll get an annual tax statement. It's worth understanding because then you don't worry so much about some of these things that we've been talking about, but you don't need to do anything with that. The vast majority of people will not need to
Do a thing. Yeah, it's all done on your behalf. If you worry that your PIR was wrong and you think that you've been under or overcharged, what do? Get in touch with the IRD and they will be able to work out whether you have been over or undercharged and work through that. We will drop a bunch of hopefully useful resources into the show notes.
The usual Sorted have got great things. CanStar have got an interesting guide. Money Hub.
Our favourites.
Yes, have got the definitive guide to tax. And then IRD actually also has some really useful information. So if you hadn't had enough tax after this wee podcast and you want more...
Hopefully this hasn't confused you more. Know that you're not alone. Jenny and I are not big fans. We don't mind paying it, but we don't like thinking or talking about it. So this was not the most fun podcast to research.
It's been really challenging. I actually spent hours, this is probably not good to admit, but hours looking for jokes about tax.
So let's finish with a few of your best jokes.
They're so bad. Do you really want to hear one?
We'll just run through them really quickly.
Hold on. Okay. Why did the goose have a big tax refund?
Why?
Because his bill was tax deductible.
Everyone get that? I really like this one, so I'm going to do it for you.
Hit me.
What do a pelican, a vulture, and the IRD have in common?
I don't know, Liv. What do they have in common?
They all have big bills.
See, and these are the best.
Okay. Cool.
Okay, sorry guys. That was
So in a nutshell,
pitiful attempt.
it was, but we tried. So KiwiSaver tax is a very complex subject, but once you understand the basics, I think it can just be not necessarily easy to understand, but less scary, and it makes sense. I think overall, you're paying tax for good things, right? To make a functioning society.
The best way to think about it.
Yeah.
Yeah, thanks for sticking with us through this riveting episode about tax.
Yes, and as Jenny wrote here, may your returns be strong and your PIR correct.
Oh, full of the humour today. Thanks, Liv.
This podcast contains personal opinions and is intended to provide educational information only. It doesn't relate to your particular financial situation or goals and is not financial advice or recommendations. Simplicity New Zealand Limited is the issuer of the Simplicity KiwiSaver scheme and investment funds. For product disclosure statements, please visit Simplicity's website simplicity.kiwi.